Hey traders, this is Blake Morrow with Traders Summit, and I have Jim Welsh, Macro Tides. He's with us today. It is Friday. He's giving us a breakdown of what he sees, coming up, what's happened throughout the course of this week, and it's always nice to talk to him on Fridays. So, Jim, welcome.
Hey, happy Friday.
Happy Friday to you. So, it's been obviously a very volatile week. We saw a big breakdown in gold, and I know you want to talk about gold, but the S&P is getting itself comfortable below this 3,900 level, which has been pretty critical support. I have to say the comments that came out of FedEx were a little worrying overnight. Yes. But how are you seeing the markets right here?
Well, again, I think the market's got a wake-up call from the CPI report, obviously. Yep. As you and I have been talking for really a number of weeks, that there's this overemphasis, in my opinion, on inflation. Wall Street has thought, gee, once inflation peaks and comes down, the Fed can pivot. And as I've written, and as we talked last week, I think the labor market is the bigger focus going forward for the Federal Reserve because of wage growth that is much more sticky inflation. And that is why the Fed was likely to raise the funds rate to a modestly restrictive level between 3 3/4, 4 1/4, but then hold it there. And that's contrary to obviously what the Wall Street has been expecting with, they're going to bring rates up and they're going to bring them right down again. And I think they're missing the point. The Fed wants to avoid the 1970s mistakes where they aggressively raised rates and tightened too much, and then were forced to pivot and lower rates quickly. And the net result was that during the 70s, we saw inflation hit higher highs, the plateaus were higher. I think the Fed has charted a different course. Whether they'll succeed or not remains to be seen, of raising rates not too high in their view, but then holding them at that high level so that the economy doesn't quickly drop, but gradually slows, and the unemployment rate makes its way up towards 5%.
Yeah,
that's,
okay.
I think, their strategy.
And so let me ask you this then, based on what you're saying. You still recommend that we should be paying attention to inflation, because that's what, even though you're kind of signaling to us what the market will eventually focus on, market's still focused on inflation. I mean, we had inflation expectations today that came out from the University of Michigan, and the markets are reacting to that. So, but they will be shifting, and their focus is going to turn towards employment. That's what you are saying.
Yeah, I mean, again, is the Fed happy to see inflation come down? And as we talked last week, I think the CPI will be under 5% by next March, the March CPI report. But that's not going to get the Fed to immediately say, okay, we've won that battle, now we can change our course, because wage inflation is sticky and labor market tightness isn't it. Powell's called it extreme. And if you look at all the recent data points, and I'm not talking about the jobs report, the JOLTS survey, the number of people quitting jobs, getting higher pay. You look at the deal with the railroads, a 14% increase in pay. So the wage inflation psychology is in fact taking hold. And that's why I believe the Fed is really focused on the labor market at this point in time. And so how do they address that? I don't think they want to cause a recession if they can help it. All right. That doesn't mean they're not going to respond if things go off the rails and the economy really shows much more weakness than seems likely at this point, per the FedEx call. Is the Fed going to respond? Of course they're going to respond. But I'm talking about what is their game, the flight path that they've charted for policy going forward to the next 3 to 6 months.
And that's probably a good segue for us to bring up your first chart of the Fed funds futures after CPI, right? So explain this chart that you brought to us today.
Okay, this is basically the Fed funds futures, and they're pricing in a week ago before the CPI that the Fed funds futures would get up to about 390, 395. And then, as you can see, after March of next year, slowly roll over and head down. The only difference is that after the CPI report, and people all of a sudden saying, oh no, they're not going to do 75, they're going to do a full 1%, which I do not think is coming. Now the Fed funds are up to 447 in terms of where the peak will be. But you can see the shape is identical to what it was a week ago before the CPI. The expectation remains the Fed's going to raise rates up and then bring it down. And again, we've talked about this a lot of times. People believe that this market is telling us something. Now, in December of last year, after inflation hit a 39-year high in November, and Powell said inflation wasn't going to be transitory, the Fed funds futures were pricing in 3 quarter-point increases for all of this year. So talk about a bad miss. So again, I always call into question that people, rely on this stuff as gospel.
Yeah, and they were obviously the conversations we were having a year ago is way different than what happened in reality. Fast forwarded to a year, right?
Right, and back in January and February, Goldman Sachs was, they'll have 3 rate increases. I said, no, they're going to front load the rate increases in March, May, and June. No one was saying that kind of stuff. So again, I don't take my cues. I think you pay attention to those things, but then I always ask my question, is that market right about that? So it's like the stock market peaked at 4,800 in January. Was it telling us that everything was going to be okay on the inflation front and everything else? Markets are almost always wrong at tops and bottoms. And so those who put blind faith in it, to me, are just, they're, wrong. That simple. So now the Fed funds future, or this is how many increases the Wall Street, the Fed funds future. Oh, we're going to get another 191 basis points in increases. I don't think that's likely, Blake. We're going to see more evidence that the economy is slowing.
So you really are, you were betting against the herd at this point, as far as their expectations go. Okay. All right.
Yes. Right. Yeah. Hey, I just think, again, the messaging from the Fed is getting the funds rate up to a level that is restrictive modestly, and then holding it there. They don't want to overdo it. And so to me, I think there's a chance next week at Powell. Yep, they go 75 bips because of the CPI, how the markets are expecting that. So from a credibility standpoint, they're kind of dragged to doing 75. But in his Jackson Hole speech, Powell made the statement, at some point in time, the pace of rate increases will back off that. And I'm paraphrasing. So again, I believe the Fed wants to get the funds rate up to a level and then hold it there so that they don't tip the economy into a recession. And I just think markets have overreacted because they're not listening to what the Fed is saying, and they don't understand, I think, monetary policy.
Oh, well, that's a yeah.
But it's been going on all year, Blake. You and I have been talking about this stuff consistently, and that's been one of the things that's happened over and over again this year, where the markets come up with these narratives that they're always bullish. What a surprise. And they're not listening to the Fed. And then, oh my God, the Fed did raise rates expeditiously to 2.5. So the S&P went from 4,600 to 3,650. And then, but now they're still going to cut rates because we're in a recession. No, we're not in a recession yet. And then Powell delivers.
I got to ask you. So the next quarter that we are in negative growth, are you going to finally say that we are in a recession?
We're not there yet.
Okay. All right.
Will I react? Hey, if the data suggests that we are in a recession, and again, I think we all have to, put our thinking caps on and really look at more than just the GDP report, because there's been noise in the GDP report. The first quarter was subtracted, as we've talked, 3.2% for trade. Well, the trade deficit's gone from 124 billion in March to 70 billion. Trade is now adding to GDP at a time when the economy is weakening. So should we just take that at face value? No. Inventories are getting adjusted. Well, they subtracted a chunk out of the second quarter GDP. So yeah, I'm just going to look at the data. When the data, to me, looks like, yep, we're in a recession. And as you know, I felt that a recession was likely next year. Yeah. Just not this year. At the same time, the Fed has raised rates pretty aggressively. The lag time that normally happens between changes in monetary policy and the impact on the economy, everybody says 6 to 9 months. Well, what I've said is with the increase in rates, that time frame should be shortened because of what the Fed has already done. So no, I'm not trying to be stupid about this and dogmatic. But I'm going to push back when everybody else is saying things that I don't agree with.
Okay, well that makes perfect sense to me. So let's talk about this update that you gave your traders.
So
This is via
yeah,
Macro
I
Tides.
thought, yeah. Okay. So my expectation was that the S&P would rally to 4157, which was the 618 retracement of the decline from 4325 down to 3887. Interesting thing, the S&P futures, Monday night and just before the CPI report came out, Blake, got to 4158. So the S&P futures did in fact retrace the 618. My expectation was that once we got up to 4157 on the cash, we were going to see a pullback. So, basically the CPI kind of truncated that. But because of the miss, I thought, oh yeah, I'm going to put out an update. And to me, that suggested that we were going lower.
Okay.
That we were going to test 3887, take that out and go lower. Because again, this underscores the emphasis that Wall Street has put on, gee, if inflation comes down, happy days are here again. Well, they didn't get what they wanted. I mean, a 0.2% increase, difference than what the expectations was. So to me, again, I just think that underscores that Wall Street's perception of what's really pushing monetary policy was wrong. And the reaction on Tuesday to the CPI report and stocks supported that. We're still in a bear market camp. So when you're in a bear market, surprises typically happen to the downside, just like in bull markets, they happen to the upside. So to me, the market is starting to wake up to, gee, the economy is going to slow. The risk of recession is rising. As I pointed out a few months ago, out of 14 tightening cycles going back to 1947, the Fed has achieved a soft landing 3 times. That's 21%. So the odds were never with them.
Yeah, that's interesting. All right, so you brought the S&P chart. We're obviously breaking some Brainerd lows. It's apparently according to your chart. So what? Tell us, how do we read the S&P here? Because it is a bearish breakdown. I know there's still a lot of time left in today, but it looks like it's Friday. I don't know if anybody's willing to step in front of this train right now. It looks like we're going to close below 3,900. So what are your thoughts here?
I think that breakdown is significant. I mean, again, my expectation, Blake, was that we would rally above 4119 and then have this breakdown. So what happened is the CPI basically truncated the idea of, from the Brainerd low, that rally to 4119. My expectation was that was wave A. This pullback is wave B, and we're going to get a rally above 4119, and that's going to provide an opportunity to go short. I mean, that's what I said a week ago. Well, what happened is the CPI came in and blew that pattern, if you will, up. And, 3,900, for obvious reasons, you look at that red horizontal line, has been both resistance and support. Taking that out means something. And so I think we're going lower. That's simple.
So how much lower do we go? Do we trade? I like, for me personally, I'm targeting 37 and change, like 37.15. But for a specific reason, what are you seeing, and how far do you think we can go?
I think the lower we go, and if Powell makes a reference to what he said in Jackson Hole, at some point in time, we're going to have to ease back on the pace of rate increases. That will be a lifeline for the market to have a rebound. But again, I think people have misjudged the path the Fed is on. The Fed or Powell at his Jackson Hole speech really conveyed conviction in terms of, we have a job to do and we're going to do it until we're done. Okay. And what that means, so I just think people have chosen to believe that they will pivot. And if the economy gets weak enough quickly, will the Fed back off? Absolutely. But then you have to think about the ramifications. If the economy proves to be so weak that the Fed is forced to deviate from the path they set out on, what's going to happen to earnings expectations? They got to get marked down, So that means you get a flush before you get a reversal on the Fed pause. So I think right now you just have to, we're in a bear market. You have to respect that.
Okay. Well, let's talk about the dollar, because I thought the dollar might be in a topping pattern. Now,
Yep.
it looks like to me the dollar wants to surge higher. Prove me wrong.
I can't.
Okay.
No,
All
I mean,
right.
again, you really need to see things break down. I was in your camp. I thought, okay, that break, I
Yeah.
thought we were going to get a bounce.
The CPI did it. It worked us, right? If you were
Yeah, it did.
thinking there was
It
going to
did.
be a shot at the bearish reversal in the
Right.
dollar, the CPI really put an end to that argument.
Right. So I think that again, I use a 5 and 13-day exponential moving average, and you can see it almost crossed a few days ago. The red and green lines.
Oh, right here. Yeah.
It didn't. But the bigger picture is, I think the dollar is nearing a fairly important high, that there's a retracement to 105 coming and potentially lower. Is just, technically it has to do that. So it hasn't quite provided us, but a peak in the dollar will be significant. There was one other chart, and hopefully you have it, like regarding TLT.
I do not have that chart here, but do you want me to pull up a chart of TLT?
Please.
Let me see if I can. Give me 1 second. I'll do that. Just
because this is something I've been talking about for the last few weeks, and basically it's looking at the chart of TLT going back to March of 2020. So if you want to do a weekly chart, that might help. And the labeling I'm showing, and I really apologize, I thought I had sent you that chart.
No, it's TLT coming right up, and let me pull up that chart for you. You should be able to see it now.
Okay. So what I'm looking at here, Blake, is from the highs that we're doing 1, 2, 3, and 3 ended in June. I thought there would be a rebound, and but that potentially the decline was over, and that we were going to get a rebound to 120-ish. Exactly, it happened. Said, okay, we got to sell. That rally off that low is too choppy, so on and so forth. That sets up potentially a decline to lower low, but we've gotten it. But I believe this is wave 5 from that high in March of 2020, and that you got to buy TLT.
So you buy it here at the lower low, or do you think we can go a little bit lower? Because if I did a little bit of
my recommendation on Monday was to look to buy TLT below 106. It got to 106.24 and has bounced.
Okay.
So I might be trying to be too cute in terms of buy it perfectly. But if I'm right that this is the end of wave 5, at a minimum, a rally to 120, wave 4 of lesser degree is coming. And you're talking about a decline from 172, call it to 106, if it works out that way. 66 points, 50% retracement, 33 points from 106, you're above 130. So I just think we're at a point where we're likely to see TLT make a low here really soon. We talked about this last week, and then have a fairly significant rally.
All right. So, well, I mean, what's that going to do to gold? Because you brought a chart in gold, and gold is breaking some pretty key support. And one thing I need to note about gold is we're holding below, the 1680 level. Actually, today's rally following
yesterday's purge.
Yesterday's stop run, it went up to 1680 and held. And so right now, I mean, your chart says 1677 current price. It is trading just a few dollars below that, but basically the rally stopped at the breakdown point. So I mean, technically it's doing what it should do in a bearrish market. But do you have some reservations? What do you think?
Yeah, well, again, I was wrong about gold. I thought we were going to see a rally to 1805 to 1815. That the rally from the 1689 low, I guess that was mid-July, up to 1805 was wave A, and that we were getting a wave B pullback, and we were going to see a wave C above 1805, and then we'd have to see, okay, what happens.
Yeah, I mean, you were basically making sure that we weren't going to create a lower low, but
that was the premise of the whole rally idea.
Right.
We've taken that out. So now I'm a little bit from Missouri, and it's like gold has to prove to me. And you're right. It rallied right to the breakdown, has pulled back. So the one thing that, I've seen often with gold, they run the stops and then it reverses. So I don't want to just, okay, gold is dead. There's no chance whatsoever for gold to rally. I'm not in that camp. In part, sentiment is really bearish. And positioning, the Commitment of Traders report shows the positioning of commercials, producers. They have very, very short, small short positions. So historically, that's been what happens near intermediate lows. So I think it's not, I'm out. Okay. It took out the stops yesterday. I'm out, but I'm also paying attention so that it's like, okay, got thrown a curveball. So, oh my goodness. If it can get back above that 1680 or so, then one has to reconsider that was just a false breakout and that we are going to get a rally.
Yeah, I mean, you want to really screw shorts right now is get a nice weekly close below 1680, and then next week we ramp it right back up above 1700, and that's markets are pretty efficient at trying to screw everybody on every side, and this would be a good example of screwing the longs, then screwing the shorts. Not saying it's going to happen, but you definitely have to keep an open mind, right?
That's all I'm saying. Exactly. Yeah. Keep an open mind. There's some reasons to kind of be skeptical about that breakdown, but we're at the place where the market gold has to prove itself that was just a fake flush job hitting stops. But obviously it's somewhat dependent on the dollar, I think, rolling over.
Yeah. That's a great point. Well, Jim, I tell you, I love the fact that you're like, hey, I was wrong. Takes a big man, no, and we all have to do it. We all understand the fact that we are traders, and we do take losses in the face of, I make public calls all the time, and I'm not always right, and that's just how it is. Right. And you marry technicals with macro, and you do such a great job at it. You don't run victory laps all the time. You take, if you're wrong, you're wrong, and you admit it.
Yeah,
it's great, and I'm proud of, I'd say I'm honored to be able to follow your work. So how do I get to follow your work as a trader that's just listening to you?
macrotides.com, and if you want, I'll give you a sample letter, jimwelshmacro@gmail. But thank you for those. Again, markets are tough, and what we're dealing is in probabilities, and we use all kinds of different tools to hopefully skew the probabilities in our favor. But there's always that 30%, 40%, 50% chance that we're not going to be right. And then it's a question of managing that risk. And you're right, that's what we need to do. And, and one has to follow that discipline.
Yeah, absolutely. Well, Jim, I want to thank you for your time as always. I love catching up with you on Friday. We during the week we all have our head on a swivel, but being able to talk to you every Friday kind of puts my head back straight. So thank you for that, and I'll look forward to speaking with you next week.
Hey, thank you, Blake. I really enjoy our conversations.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.